My name is Thiago. I'm a professor, assistant professor of finance here at STU. I studied here like around 4 years ago. My research area is in asset pricing, so it's the same thing that I teach in the masters, and it's an area within finance.
What is asset pricing?
Asset pricing is similar to pricing. Like if you think about a hamburger, and you think about the price of a hamburger, it's relatively easy to price because if you want to know the price of the hamburger, you just need to look at how hungry you are, how hungry people are in general, how much it costs to create a hamburger, and then when supply and demand intersect, you know that's the equilibrium price for the hamburger because it happens today. One different problem happens when you have when you think about the price of the hamburger today. So if you need to pay today for a hamburger that you're going to receive tomorrow, that's a problem because you don't know how hungry you're going to be in the future and how the prices are going to be in the future. So this problem of pricing something that happens in the future is what asset pricing does.
What is capital asset pricing model, CAPM?
The capital asset pricing model, it tells you, instead of telling you the price of the stock, it tells you the return, for example, of a stock. And the idea of the capital asset pricing model is that the return on the stock is going to be given by the risk of the stock, and this risk is measured by how much the return on the stock co-varies with the market return. So if the market goes up and the stock goes up a lot, this is a riskier stock, because on the other hand, when the market goes down, this stock goes down a lot. This type of stock in equilibrium, when you put together sellers and buyers in equilibrium, this stock is going to have a lower price, and because it has a lower price, it's going to have a higher return. Different models that use different factors to price the stocks. For example, for the CAPM, it's just the market premium, and that's the market risk factor. There's only one factor in the CAPM. But recently, not even recently, like in the 70s, in the 90s, we already started to use some models that use, instead of using just the market as the source of risk, they use some other sources of risk. One relatively famous for here in finance model is the French model, which uses, on top of the market premium, it uses also the size premium and the value premium as two other risk sources. And there are several. The thing is that as you increase the number of, as you increase the complexity of the model, you start to have more factors that explain the returns. So there's no single answer about the number of factors.
What is the correlation between asset pricing and interest?
Let's say that we go back to the hamburger example, and I'm telling you that I'm going to give you a hamburger in 1 year from now. And then in 1 year from now, you know that this hamburger is going to cost $10. Now, if you have two alternatives. You can either buy the hamburger, or the whatever asset that's going to give you this hamburger, or you can put this money in the bank. What happens when the interest rates go up is that your opportunity cost, which is your alternative of what you can do with your money, it goes up. For example, if you put $10, or let's say it's 100% interest rate, you put $5 in the bank. This $5 is going to become the $10 that you need at the end of the year. So it means that for something that is valued at $10 in the future, you are only willing to pay $5 today, assuming that there's no risk. And this is the relationship between the interest rate and the price, the current price of an asset. And if you are, for example, in this case where the interest rate is 100%, then you're going to be willing to pay $5 for the hamburger that costs $10. If the interest rate goes to zero, then you're willing to pay $10 for the same hamburger. So you have this negative relation between the interest rate and the current price that you're willing to pay.
How does the stock market work?
Well, the stock market is It's a market, just like a market for anything, just like you have markets for cameras, for anything. You have the buyers and the sellers. Or in general, you have producers and consumers when you're talking about things that you can actually see. But for stocks, you have just the same thing. You have the companies that are looking for funds, and you have the investors that are willing to provide the fund. And these companies are going to get money from the investors by selling stocks. So what you have in the market, the stock market, is this transaction between the companies providing the stocks, the sellers also buying the stocks. This is the primary role of the market. But then you have the secondary role of the market, which is, well, you are an investor, you already have the stock, and you want to sell to another person your stock because you need the money, for example. And then you need to have a price to sell this stock to someone else, and that's how the stock market works. There are basically two. I think there are two ways to think about stocks. There are like the people who believe in, who believe. It's not really a religion, but there's this idea that the return that you get from the stocks is exactly the same, is exactly enough to offset the risk that you have for the stock. So if you think from this perspective, there's this question about which stock you should buy or sell doesn't make much sense, because in equilibrium, what you're going to be getting from like the higher return, let's say, that you get, is to compensate for a higher risk. And this is like the traditional orthodox way to think about asset prices. And that's what we try to, most of the research that we do is to try to explain what are the risks that are associated with these returns. Now, there's another area of finance that believes that people make mistakes, like they make systematic mistakes. They have these behavioral biases, so they don't really know how to calculate the prices of the stocks. If you believe in this type of and there's a matter of debate, but if you believe in this type of reasoning, then you could think that every time that you find in the market some stock that give high returns for some measure of risk, some accepted measure of risk, those would be the good stocks to buy. And then there are several stocks that people argue that that you should buy if you want to make money, for example. Like, for instance, the factors of Fynboen French that I said before, the three factors: the small stocks, value stocks, these is momentum stocks. These stocks are stocks that they signal, or they are kind of examples of puzzles for the current risk-based explanation. So, at least based on the model that we have so far, we cannot explain why these stocks give such high returns. So they would look like the best candidates for the stocks that you should actually buy. We have some measures of risk. So, for example, for the CAPM, which is the basic one, how the stock varies with the market. This is a measure of risk because what this means is that when the market goes down a lot, the chances that you will need a lot of money, that you will be in a situation where you would really like to have some money, like, for instance, when your bike gets stolen, or when your fire, when your house gets burned or something, when you have a big loss, you would really like to have something to compensate for that loss. So if the stock goes down exactly when the market goes down, then exactly at that time when you would like to have something to make up for that loss, you are losing even more. This type of stock is risky from this perspective. And this is the story of the CAPM. That's the measure of risk of the CAPM. But then you have several other measures of risk, because the CAPM, for example, doesn't include in the calculation anything related to job opportunities. Another example is when you lose your job, you would like to have something to give you a return. So there are like all these, that's related to the question that you had before about the risk factors. So one is the market factor, another one is how you're doing in your job, and the other one is how the economy is doing in aggregate. So it's difficult to tell which one source of risk is the one that drives the returns.
How can a stock return be forecasted?
The problem with economics in general is that we don't have a lab, so we cannot just generate some stocks in the lab and put people in the lab and say, okay, buy stocks now and we're going to see how it works. What we more or less need to do is we need to use some statistics to figure out what's actually happening after it happened with the data that we have. And one way that we do this is by looking at what we can call like state variables. So those are the variables that tell us what are the conditions of the economy in general. So state variables would be something like the interest rate, the current interest, or the interest rate in each period, or the macroeconomic variables like GDP growth, or some other variables that are more related to stocks, which are like the multiples, like price earnings ratios and etc. So those are aggregate values that we use to determine the state of the economy. Then after we have these variables, we run some regressions, which are like we try to look at the relation between these variables and the return on the stocks, and then we try to estimate this type of what the connection is, and then we see if it aligns with some theory, and then we can say, okay, it actually forecasts or it doesn't forecast stocks.
How do you analyze the correlation?
What I basically use, everyone uses different ones, but what I basically use is more simple models, which basically linear regressions. I just look for linear relationships between the variables, and what's important is that it's not only about regressing trying to find linear relations or correlations between variables, but it must be we must think about variables that make sense theoretically first, and then we see if we can find the relation, because otherwise we have several problems with this. Is that you're going to find something that looks like it works in the data, in the sample that you have, especially because we don't have laboratories. So it will look like it's perfect in sample, but then you cannot use it out of sample. So what we really want is something that makes sense, which means that it has some theoretical framework behind it, and then we look for the actual data, what the data says, if it's true that what we thought or not. The line of research that I follow, we try to make it as simple as possible, because as soon as you start to use more complex models, then we start to have a lot of room for bad estimates in the parameters. Because what really is different from really sets apart economics from like physics and biology and all these other sciences, that they can run everything in laboratories, so they can be very precise with their estimates, and they can have very well fit models with all the points very well correctly, very well estimated. In economics, although people like to think that we get the point estimate very precisely, we don't really get the point estimate very precise. We have more or less an idea of what's going on in the data. And to get an idea of what's going on in the data, it's easier and it's better, it's more robust if we make a very simple model, like a linear regression, and then we just try to see, okay, if this variable goes up, this variable goes up also, which is basically what a linear regression tells. And then if this is true, we say, okay, let's say that you increase, for example, interest rate. What's going to happen with the prices? It goes down. For this type of conclusion, we just need linear regressions. An exponential regression would give you, okay, if it goes up 1 by 1%, if it goes up by 1%, is it going to go up by more than 1% or something like that? And that's kind of harder to say. When Newton was there on the tree, and then he saw that the apple was falling, that was a puzzle for the time, because they didn't know why the apple was falling. So this is something that they saw in the data, and in the data, in this case, it was just looking at it, but they didn't know why it was happening. And then after that, they started to think about what they had, like what was it that was attracting the Earth to the apple, and why exactly the apple was falling. So it started with a puzzle, and then it ended up with a theory that explained the puzzle and explained a lot of other stuff. And what I do in my research is I look at, basically what I do is I look at a few of these puzzles that we have. Those are not puzzles for like as important as gravity, but they're puzzles like, for instance, some stocks that give too much return for the models of risk that we have. And I try to understand why they give so much return. So, for example, if you think about small stocks, that's one of the things that I was studying. Small stocks, they give too much return for the risk that they have. So, why is it that they give so much return? Or which type of theory could explain why this is happening? And when I do this, what I actually do is I don't need to collect the data, because the data is already collected, it's already documented, this is already a puzzle that's documented. I just need to come up with theory and see if it explains the data. So I come up with a theory, I try to find something that I can measure. That's very important, to find something that I can measure out of the theory. And then I get the data of like, for instance, state variables, etc. And then I test in the data to see if the story really goes through for that type of stocks, and then I try to expand it afterwards. So there's not a single, I'm telling you all this story because what I want to say is that there's not a single method that I use for everything. It's kind of the single thing that I use for everything is this procedure of get the theory, try to measure it, to make it measurable somehow, and then I test it in the data, see if it really is the way that I thought that it was going to be, if it confirms the story, and if it confirms the story, then I write a paper and that's it.
What is the newest model you developed?
The latest is actually for a phenomenon that's called momentum. It's actually the coolest one. Momentum is this. Momentum in stock returns is the fact that if you look at the past, like say from today until 1 year ago, if you look at the stocks that were the best ones that performed better in the past, these stocks tend to perform better in the future also. And this was a puzzle. It's still a puzzle because I need to convince other people that it's not. But this is a puzzle because when you think about the stocks that performed better in the past, these stocks are not necessarily the riskier ones from a CAPM, if you think in terms of the CAPM. So they look like they are actually the safest ones. So you have, so this creates the puzzle because in one side the CAPM is telling you that these stocks are very safe, and on the other hand, when you look at the data, these stocks give very high returns. This mismatch is a puzzle. And what I did in the paper is to explain that what actually happens is that the CAPM doesn't really tell you that these stocks are safe. It looks like these stocks are safe because the stocks that are winners in one period, they tend to be risky in one period, but then they tend to be safe in the other period. So you're really mismatching everything when you rank the stocks in this way. And when you adjust for this type of mismatch, then you see that instead of being a negative relation, you have something like a quadratic relation, and that looks like a negative relation. UPL, for example, in the US, it was a fracking company, an oil fracking company. This stock was doing very well when I looked at the period in the past. So momentum works like that. It's a 1 year return. So in the past year, the stock was doing very well. And I didn't understand what exactly was the risk of the stock. And the risk of the stock was precisely the oil risk, because then the stock was doing very well, as if it was the investors were surprised every time the stock was posting a profit. But what happened is that when oil prices started to go down, fracking became very unprofitable, and then the stock started to go down very, very much. So the stock looked like the stock was a momentum stock because it had a very, very good past return. It looked like the return was going to continue, but then it didn't continue exactly because the risk materialized, the risk that the oil prices went down. So this is like one example of a stock that looks like it's going up, and then when you see there is always, that's going back to the beginning, that's always the idea of this type of research that I do. There's always a risk. You just might not see what the risk is, but it is. It should be there.
What is your next research focus?
We have all these puzzles, like a few of these puzzles, and what I'm trying to do now is to find a measure to systematically forecast all of them. So now, for example, if you are going to invest in small stocks, when should you invest in small stocks? Or when is it that the return is the highest? When is it that the return is the lowest? But then for small stocks, value stocks, and then a bunch of other new puzzles.